Hello and welcome to today's video. As you're likely fully aware at this point, it has been a dreadful year for investors. It has actually been that bad that if the year ended today, it would be one of the worst years on record in US stock market history. What does it look like though for more diversified investors? Here is a look at the worst calendar year returns for a 60% equity, 40% bond portfolio going back to 1928. Many of the worst years for a 60-40 portfolio are the same as the worst years for the US stock market, which makes sense since the 60 carries much more risk than the 40 in this equation. If the year were to end today, the current year-to-date return of about -12% for a 60-40 portfolio would be the 6th worst annual return over the past 100 years or so. Since bonds are having such a rough time of it, and during a year when the stock market has entered bear territory, this year is currently on par with 60-40 returns in 2008 and 1930. If stock market returns were the equivalent to dinner party guests, then 2008 and 1930 would not exactly be ideal company. Of course, it's just one year, and you should expect to have bad years when investing, because despite what you may have heard from some during the market run-up from March 2020, investing is not always easy in the short term. What about the returns that really matter though? The longer term ones. Here are the worst 5-year returns for a 60-40 portfolio. So we're looking at 4 times over a 5-year period when 60-40 was negative over 5 years, and they all occurred in and around the Great Depression. Now let's go out 10 years. There has never been a negative return over 10 years for a 60-40 portfolio as of calendar year end. Could it happen? For sure it could. There is absolutely no such thing as always or never in financial markets. Still, it is not a bad track record. Before we go, how about one more? Here are the worst 20-year returns. It's worth pointing out that the range of annual returns for the worst 20 years listed here for a 60-40 portfolio is 3.4% to 6%. That is pretty good for a worst case scenario, right? I don't think you'd be short of takers signing up for 6% per year for the next 2 decades right now. Of course, past performance is not indicative of future returns, but sometimes it is helpful to zoom out a little when you're in the thick of a rotten year. Before I go, I have to say a big thanks to Ben Carlson for providing the excellent charts. If you have any questions on today's video, please drop us a comment in the section below. Have yourself a fantastic rest of the day.